Tax laws are complicated, but tax strategies don't have to be. Tax strategies made simple right now on Retiring Today. Welcome to Retiring Today. I'm Molly Nelson here with Chawn Honkomp and Loren Merkle. They're both certified financial planners and certified financial fiduciaries. Chawn is also a CPA. And as a former CPA, we're talking about taxes today. I have to know you were practicing CPA for part of your career. Have you read the entire tax code?
Probably haven't read all of it. I know there's quite a bit, and it constantly grows and changes. So it takes a lot of work to stay current on everything that's going on with the IRS tax code.
Yeah, like some 9 days, they say, to read the entire tax code. If you read it, it would take up to 9 days, but it would take a lot longer, Loren, to understand it.
Maybe 9 years to actually get all the information. And of course, it does change all the time. So if it really took 9 years to read it, you're reading something that's out of date, which is why it takes an entire team of professionals to actually apply that tax code to your situation in the most meaningful way so you can actually use it and perhaps not pay more than you have to.
Here's what I found out about the U.S. tax code. It's about 6,000 pages. When tax regulations and official IRS guidelines are added, it's about 75,000 pages. Now, guys, it hasn't always been this way. Take a look at this. Back in 1913, just 400 pages, but each year those tax codes have grown. Today you can see how those papers stack up, 75,000 pages. So guys, we have a challenge today though, and I think you're up for it. We want to make it simple. Do you think we can do it?
We can do it.
Yeah, let's do it.
Okay, taxes made simple. Before we talk about making some of these strategies simple, let's make sure everybody understands why we want to make it simple for them, Loren.
Because especially when we're considering your retirement tax bill, it probably represents your biggest opportunity to increase your spendable income. In retirement, it's not about what you make. It's what you keep, it's what you get to spend. And by decreasing your retirement tax bill, that's one of the most effective ways that you can increase that spendable income.
And we'll get into the specifics, Chawn, but one thing I've learned over the years of hosting this show is that in retirement, you have more control over taxes than you've ever had before.
Yeah, that's what you want to be thinking about is this, get into this retirement journey and we start thinking about what taxes might look like. You can just do what you've always done. You can show a certain amount of income, or you can take control of it. And you have more control now that you've got to build an income plan out of the different assets you've accumulated. You can make different decisions and look at each year and try to maximize that year. We're going to try to help you minimize the total tax bill that you're going to have over the course of your entire retirement journey.
So we want to take some of these tax strategies and make them simple. And of course, like a lot of the stuff in the financial world, even the names of these strategies are somewhat complicated or at least goofy. The first one we want to talk about is tax loss harvesting. And of course, you're a farm kid. You grew up in a rural area. The harvesting part of this is kind of just funny. The name alone kind of makes me chuckle.
Yeah, it sure does, but we can make it easy. And in fact, we have an example to make tax loss harvesting easy. It's probably one of the most overlooked tax planning strategies, and in part because of the complexities. There's not a lot of individual investors that incorporate tax loss harvesting strategies. Not even a lot of advisors incorporate these strategies, but we will make it simple. This is something that we do for the families and individuals that we serve. But first, what is tax loss harvesting? Tax loss within your portfolio, inevitably at any point in time, you probably have some gains in your portfolio. You might also have some losses in your portfolio. So tax loss harvesting is simply using the losses that you have to offset the gains to reduce, or in some cases, maybe even eliminate your tax bill for that particular year. So let's give you a specific strategy or example of how this could work. Let's say in your portfolio, you have tech stocks. These are the high-flying tech stocks. They've done really well, so you have experienced gains in your tech stocks. But then you have your healthcare stocks that haven't fared so well. Now you're looking at your tech stocks flying high, your healthcare stocks depreciated, and you're saying, whoa, maybe I'm not as diversified as what I should be. I need to take some profits off the table with the tech stocks and then realign those proceeds to re-diversify your portfolio to make sure you're not taking any more risk than what you want to take. So what you do is you sell a portion of your tech stocks and you realize $20,000 of gain based on the sales of your tech stocks. Now you have a couple options. Do you tax loss harvest or do you not? If you don't tax loss harvest, then you just simply realize the $20,000 of capital gains, and you're going to pay capital gains taxes on it. Most people are going to pay somewhere between 15 to 20% based on the taxable income you have for that year. So based on $20,000 of gain, maybe $3,000 to $4,000 of tax in that year based on the capital gain sales. Or option number 2 is you can engage in tax loss harvesting, which means you're selling a portion of your healthcare stocks, realizing in this case $20,000 of loss, and that $20,000 of loss is going to offset the $20,000 of gain that you had in the tech stocks, which means you're going to have $0 of gain, which means your capital gain tax is going to be 0 based on those transactions that you had with the tech and the healthcare. So in this scenario, you are saving by engaging in tax loss harvesting anywhere between $3,000 to $4,000 of capital gains. Now I know what you're thinking. You're saying, Loren, I've always been told that how we make money in investing is we buy low, we sell high. That's correct. You're also saying, Loren, you're telling me we should actually sell low some of these healthcare stocks. And in this strategy, that can be a valuable thing, especially when we're looking to save money on taxes. And here's the deal. You might like some of those healthcare stocks. You might really like some of those healthcare stocks, and they only happen to be down because the healthcare sector is down. If you sell those and you use those to offset the gains that you have on the tech side, what you need to do, or what you can do, is wait 31 days, and then you can repurchase those same exact stocks if you want to, and that strategy still works. If you repurchase those stocks or like stocks within that 30-day period of time, then you cannot use the tax loss harvesting strategy and offset the gains. So you have to be careful. There are a lot of complexities when it comes to engaging in tax loss harvesting, which again is a lot of times why this strategy is not employed, but it can be a substantial benefit in tax savings.
That was the best explanation of tax loss harvesting I've ever seen, so nice work. You were up for the challenge of making it simple. A couple of clarifications though. So let's say some people watching that probably totally tracked with them, made perfect sense. Other people, maybe a new concept. I think the takeaway, Chawn, is that whether you understand the nuances of it or not, if you're not working with someone who's not at least proposing this to you, they may not be looking out for your long-term tax plan in retirement.
This is not an everyday term that people use outside of work. I'm fairly confident that phrase has never come up when hanging out with my family and friends. So if this isn't something that you do on a daily basis, this isn't going to be something that you're thinking about. So tax loss harvesting, again, you may not know what that means and how to apply it, like you touched on, Loren. So maybe you have an advisor, maybe they help you make these investment decisions, but maybe they've never talked to you about this, and that's okay. That just might not be what they focus on. Not all advisors do the same thing, and with us, one of the areas that we focus on being the tax plan. This is a phrase that comes up daily or at least weekly within our offices because we're talking about that. We're looking at the markets. We've got to identify the right times to do it, and we've got to know the right types of accounts and the balances that can be a part of tax loss harvesting.
And Loren, you did just this in 2022 with a lot of the families and individuals we serve.
When the markets go down, this represents a really good opportunity to do something exactly like tax loss harvesting. So yes, in 2022, the markets were down. The NASDAQ was down 34%, the S&P close to 20%. Almost everybody had losses in their portfolio if they had stocks. What an opportunity that could present to you to actually have a strategy in place to take advantage of the market discounts. We know the markets go in cycles. Every 5 or 6 years we go through a recession. You're going to have many opportunities to employ strategies like this when we go through these types of markets, even over the course of your retirement. Now, one of the complexities of that type of strategy is this can only take place in non-IRA, non-employer accounts, so a brokerage account. So with your IRA money, this doesn't work. Of course, you can buy and sell. You can realize losses and gains, but you can't offset from a tax standpoint. So your brokerage account is the primary account where you can employ something like this. But I can tell you, in that example, just by offsetting $20,000 of gain, $3,000 to $4,000 of tax savings, you extrapolate that out over a 20 to 25 year retirement time horizon, that can add up to some real money. And that's why we say one of the biggest opportunities that you have is to save on your retirement tax bill and increase your spendable income is engaging in tax planning.
Especially if those capital gains tax rates change. I know there's always talk of tax rates changing, and more of that money may even be taxable in the future, so more savings opportunities if the tax rates do change.
Yeah, more opportunity, and it could change the strategy because there's a lot of laws that go into that one particular strategy. Any of those changes could impact how we actually engage in that type of strategy and to what degree.
Yeah, they'll probably add a few more pages to that tax code.
Absolutely. It only goes one way.
Still to come, we've got 2 more tax strategies made simple, plus we're answering your questions next.
Do you wonder if you have enough saved for retirement? Will your money last as long as you do? Will taxes, healthcare costs, and inflation derail your retirement? Get answers. Schedule a 15-minute retirement checkup call today. We can cover a lot in 15 minutes, including strategies you can implement now to start your retirement journey. Schedule a call at merkleretire.com. The first step to a confident retirement starts with a simple phone call.
Do I have enough saved for retirement? When should I take Social Security? Which Medicare option is best? How do I plan for inflation? Sometimes the road to retirement starts with more questions than answers. We're here to help. Join us for our upcoming Journey to Retirement workshop. Get answers and start your retirement journey with confidence. Our online workshop includes information on Secure Act 2.0 and changing retirement rules. Visit retirewithmerkle.com to register for an upcoming workshop. Your retirement journey starts now.
The Merkle Retirement Planning Team provides personable and professional expertise unrivaled in this area. They include us in every step of the planning process. The peace of mind provided to us by the Merkle team allows us to fully enjoy this special time of our lives. Instead of feeling snakebit, we feel confident that with the Merkle Retirement Planning Team at our sides, we can navigate any challenge that comes our way.
Merkle Retirement Planning. Your retirement starts here.
Welcome back to Retiring Today. I'm Molly Nelson here with Chawn Honkomp and Loren Merkle. Now it's time to answer your questions from our online Journey to Retirement workshop. We call this section Your Journey, Your Questions. Here's a question we got recently. What are the tax benefits of a health savings account? We'll get to the tax benefits. We'll talk to Chawn in just a minute. But first, Loren, why don't you give us a little health savings account 101? What is a health savings account and who has access to one?
Health savings account, most people call it an HSA for short, so that's what we're going to call it. But it's just a savings account that if you qualify, you can contribute to it on an annual basis. And then you can take money out of this account to pay for qualifying medical expenses. Now, a lot of people, there is some confusion on whether or not you can participate in an HSA or not, because you do have to have a qualified high deductible health care plan in order to have the HSA. That plan most of the time will be sponsored by your employer, so you can talk to your employer, see if they have a high deductible health care plan that does qualify. And if they do, they might also offer you an HSA that they can just auto deduct from your paycheck. That makes it easy. But a lot of employers don't have an HSA set up like that. So in that case, you would go to a different institution, set the HSA up. But the prominent factor that determines whether or not you're eligible is if your employer offers that qualifying high deductible health care plan.
Okay, and if you have access to an HSA or you qualify, it can be very beneficial.
Yeah, if you can get to an HSA, you're going to love it. And the biggest reason is you get all of the tax advantages. It's the only account out there that is considered to be triple tax advantaged. And what we mean by that is, one, when you make those contributions into there, you get a deduction. You don't pay taxes on those dollars. Two, as the money is in the HSA, it grows tax deferred. And then three, as you take distributions from an HSA, as long as you're using it for those qualifying medical expenses, you don't pay taxes on those distributions. So there's no other account out there that's going to give you all of that. That's the biggest reason why we're talking about HSAs. That's why we want to know. We want to make sure that you're aware of if you have one, and then help you best incorporate that into your overall retirement plan.
And for some, it can be very powerful later into retirement.
For a lot of people, it's really tempting to make contributions to the high deductible or to the HSA and then take it out in the same year to use for the qualifying medical expenses. And if you have to do that from a cash flow standpoint, perfect, you're still getting some of those tax benefits. But if you don't have to, you can consider allowing that money underneath the HSA to take advantage of the tax-free compounding and then cash flow the medical expenses because you're working and you have good cash flow coming in. So if you can afford to do that, take advantage of the triple tax benefits that the HSA provides, cash flow your medical expenses, because in retirement, most likely you're going to have an abundant opportunity to use the HSA after you allowed it to grow and take advantage of the compounding on the qualified medical expenses in retirement.
Abundant opportunity is a way of saying you're likely going to have medical expenses in retirement, and then you'll have that money there that's been growing, and you'll have even more money to use because it's maybe even been invested and experienced some growth, right?
Yeah, when you contribute to the HSA, you do get the tax deduction up front, but if you're taking that money out right away within that year or the next year, you're not really maximizing the tax-free compounding that the HSA can provide. Now, if you have to, great, do it. You get some of the tax benefits, but if you can, allow that money to grow for a period of time, cash flow your expenses from the W-2 or other sources, and then take advantage of the triple tax benefits of that superhero that we call the HSA.
And this was one of the good questions that we got during our online Journey to Retirement workshop. We get a lot of good questions during the workshop, and they're not just about taxes, Chawn, they're about all the other things that you guys talk about in the online Journey to Retirement workshop.
There's a whole lot more to be thinking about as you approach retirement and then get through and enjoy your retirement journey. There's 6 pillars that we focus on. A big one is taxes. That's why we're doing an entire episode today about taxes. But there's the lifestyle. What's this new stage of life going to look like for you? Where do you want to live? Where do you want to travel? Where are you going to spend all that free time? We're going to help you make income planning decisions. We're going to help make investment planning decisions. There's the healthcare, and then there's legacy planning. So we've got to think about all of that. And the big takeaway from the workshop is that you find out that there's so much overlap. As we're making decisions in one pillar, we've got to be thinking about the trade-off or the impact that it might have on another part of the retirement plan.
And I'd say another big takeaway from the workshop is that you find out how you can save money. Areas where you have a little more control in retirement and areas where you can put more money into your pocket.
What a lot of people like about the workshop is we use a hypothetical couple, John and Sue, and we show you through the strategies that they implement how John and Sue can save over $100,000 off of their retirement tax bill, how they can increase their Social Security lifetime income by over $80,000, and much, much more as we go through those 6 pillars. So real actionable strategies that people can use that can make a big, big benefit to the overall outcome of the retirement plan.
I think you should meet John and Sue. Sign up for our online Journey to Retirement workshop. You can see the decisions that they make. You can go on a journey with them, and you can meet our retirement planners. Go to retirewithmerkle.com right now, and you can sign up for a time and a date that works for you. We still got 2 more tax strategies made simple next.
Do I have enough saved for retirement? When should I take Social Security? Which Medicare option is best? How do I plan for inflation? Sometimes the road to retirement starts with more questions than answers. We're here to help. Join us for our upcoming Journey to Retirement workshop. Get answers and start your retirement journey with confidence. Our online workshop includes information on Secure Act 2.0 and changing retirement rules. Visit retirewithmerkle.com to register for an upcoming workshop. Your retirement journey starts now.
Anytime I have even the smallest question about my accounts or what effect the latest tax law might have on my situation, the Merkle Retirement Planning Team is always there and quick to help. I'm so glad they treat you like family. I'm so happy to have such an excellent team working for my future and ensuring I do the best to achieve my financial goals.
Merkle Retirement Planning. Your retirement starts here.
You dream of a happy retirement, but there are some big questions to answer first. Do I have enough saved? When should I take Social Security? How will I pay for health care and keep up with inflation? Go to merkleretire.com to schedule a 15-minute retirement checkup call to talk directly with a retirement planner and get answers to your important retirement questions. The first step to your retirement starts with a 15-minute retirement checkup call.
Welcome back to Retiring Today. The challenge is tax strategies made simple. We went over tax loss harvesting. Did a great job with that in the first segment. Our next one is Roth or Roth conversions or Roth IRA. And again, these names, Chawn, what does the word Roth even mean?
Yeah, Roth, there's a lot of confusion when it comes to Roth balances. And the word Roth really doesn't stand for anything in the eyes of the IRS. The Roth comes from the name of a person. There was a senator, William Roth from Delaware, that he's the one that started talking about these different savings opportunities. He's the one that created the Roth accounts, and that's really what the Roth means.
Okay, so we know now where the name came from. I appreciate the history lesson there. What is a Roth? How does it work?
Yeah, Roth is an after-tax type of savings account. What you're most familiar with is probably the pre-tax, so think traditional 401k or traditional IRA, where Roth is just the opposite. You're going to take after-tax money, put it into a Roth. And the big reason why we love the Roth account so much is that you're going to get tax-deferred growth. And then even when you take money out of a Roth in the future, you're never going to pay taxes on that again. So you know that every single dollar that's in a Roth account, you get to keep 100% of that dollar and you get to spend 100% of that dollar in your retirement journey.
Okay, so you guys remember the 75,000 pages we talked about. There are some complications, or what should I say, some nuances, some rules to the Roth. Let's make sure we make those simple and make sure people understand.
One of the benefits of the Roth is you can literally invest in just about anything you want to. So if you have your Roth at a bank, you can invest in the bank products, whether it's a savings account, a CD, whatever the bank offers you. If you have your Roth at a brokerage account, you can literally invest in stocks, bonds, ETFs, just about anything you want to. From the other investment categories. And then from a distribution standpoint, it's a little bit more flexible as well, where any of the money that you contribute to the Roth, you can take out when you want to, and you don't have to pay taxes on that because it's already been taxed. You also don't have penalties on that amount that you contributed to it. However, the earnings on it, the earnings needs to stay underneath of there until at least age 59 and a half in order to not pay taxes on the earnings and not be penalized on the distribution from the earnings. So some of the legalities of some of the laws that you have to file with the Roth are different than these other retirement savings, which means we have to be knowledgeable about how to use them and what kind of strategies we can incorporate when we're talking about the Roth.
Yeah, I mean, there's phase-out limits, there's contribution limits. I mean, I like that you talked about the investment strategies, because the question we get a lot from you is, well, what kind of performance or what kind of return does the Roth do? And that's where there's some of the misinformation. It's not the type of investment at all. It's simply the type of account. And then another thing we hear all the time is, well, I'm age 60, I don't have any Roth. Is it too late? Yeah. I know you've heard that plenty of times. Yeah. And the answer is it's never too late. There's two main ways to get money into Roth accounts. There's the contributions, which you have to be aware of those limits, and the phase-outs, and then there's Roth conversions, which is a big part of the tax planning.
And I know that both of you could talk about Roth for a long time because there are so many benefits, but we got one more tax rule that we want to make simple that is, and it's net unrealized appreciation. Another one of those titles that just rolls right off the tongue.
But can represent a huge tax savings opportunity. This relates to company-sponsored plans, traditionally a 401k plan that has employer stock underneath of it. So your 401k plan at work, if you have employer stock, then potentially you have the ability to take advantage of net unrealized appreciation. What that means is, let's say you have $20,000 of value of employer stock. You can, if your plan allows it, take that stock out to a brokerage account, so a non-IRA account, which means you're going to pay taxes on the cost basis of that stock. So if you invested $10,000 into that employer stock, you'll pay ordinary income tax on that $10,000, and then the rest of that company stock you can allow it to continue to grow, or eventually when you sell it, you're going to pay a capital gains rate, which could be 0, 15, or 20% based on your taxable income. So it does represent a potential tax savings, but there are a lot of if-thens, a lot of rules that are associated with it, so you have to make sure you do it really carefully.
And what's the advantage of putting it into a brokerage account versus keeping it where it's at?
Yeah, the advantage is, again, to pay these lower tax rates. The capital gains tax rates that you pay in any given year is always going to be less than what your ordinary income tax is going to be. So, again, a unique opportunity isn't out there for everybody. Certainly, again, not common day language. I don't talk about net unrealized appreciation with my family or friends or anything like that. So it's not an everyday thing. So you want to be aware of it to identify, again, one of the biggest goals that we have, maximize all the assets that anybody has in retirement, help you pay less taxes throughout your retirement journey. And this is another great example of something we need to be aware of so we can make the best decisions.
Yeah, and I think the more you know, the better, right? Because you can be looking for these things and you're hoping too that the person you're working for is bringing it up to you. So one way to find out about more strategies that you could be asking about is the Online Journey to Retirement Workshop,
where we talk about a lot of the strategies in all 6 pillars, and we do it through the eyes of John and Sue, our hypothetical couple, where we show the specific goals that John and Sue have, which are probably going to be different than yours, but then we apply strategies to how they're going to accomplish these goals, which those strategies you can definitely take away and use to help you accomplish your goals. In this workshop, it's convenient, it's complimentary, it doesn't cost you anything. You can view this at work, you can view it at home, you can view it on the road, wherever you are that you have internet and a computer or a device, you can take in this information to help you on your mission to have the best retirement you can.
Yet in that Online Journey to Retirement Workshop, you give a really powerful example about taxes and legacy planning that really stretches what starts off as a modest amount of money and turns it into a whole lot of money that John and Sue get to leave to their kids and grandkids.
One of John and Sue's goals is to leave a meaningful legacy to their 2 kids. And so we walk you through a strategy that John and Sue decided to use. We call it the IRA relocation strategy. And what it does is it decreases their tax bill on the IRA money that they've never paid taxes before, and it also magnifies how much they can leave by almost 3 times how much they can leave to their kids. And the best part is they leave this money tax-free to their kids.
Tax-free, that's the best kind of money. You can meet John and Sue at retirewithmerkle.com. Sign up for a time and date that works for you and get on your journey to retirement. This is Retiring Today, and we thank you for watching.
Do I have enough saved for retirement? When should I take Social Security? Which Medicare option is best? How do I plan for inflation? Sometimes the road to retirement starts with more questions than answers. We're here to help. Join us for our upcoming Journey to Retirement Workshop. Get answers and start your retirement journey with confidence. Our online workshop includes information on Secure Act 2.0 and changing retirement rules. Visit retirewithmerkle.com to register for an upcoming workshop. Your retirement journey starts now.
You dream of a happy retirement, but there are some big questions to answer first. Do I have enough saved? When should I take Social Security? How will I pay for health care and keep up with inflation? Go to merkleretire.com to schedule a 15-minute retirement checkup call to talk directly with a retirement planner and get answers to your important retirement questions. The first step to your retirement starts with a 15-minute retirement checkup call.